Hey, this is Sasha Evdokov, and thanks for joining me here for another session about trading and investing. Now, today we're going to talk about options, and what we're going to do and discuss is talk about selling put option contracts. Now, selling puts is similar to looking for an upside in a certain stock. It is a little bit different when you're dealing with selling option contracts rather than buying option contracts. And yes, you can absolutely sell option contracts. It's not that you just have to buy a put or buy a call. Some people don't understand that you can actually be a seller of options, just like people at a dealership will sell you a car before it's even on the lot. And the same thing here with option contracts. You can sell them even if you don't have them. And you're basically selling these contracts to other people that are interested in buying them. Now, the issue is, of course, you will have to deliver what you promised based on the contract. And I'll show you what that looks like in the risk profiles and pictures, which will make a lot more sense as we go through the lesson. So let's get going on selling a put contract and show you what it's all about. Now, first, before we get into the risk profile picture, you need to understand what is a put option contract. So if you haven't heard this before, bear with me for just a second. Let's go in detail what it is. So in general, when you're buying a put contract or buying a put option, it means that you're looking for the stock to go down. In other words, you have a bearish outlook. So that's what happens when you're buying a put contract. Now, when we're selling a put option, what this usually means is you're looking for the stock to actually go up. You're bullish, and that's what we're going to be discussing right now. Is we're going to be looking at the sell side of the put option contract. And it's a little more confusing for some people. Just understand that there's 4 parts to a trade. You can be a buyer of a put or a seller of a put. And you can be a buyer of a call and a seller of a call. So there's those 4 parts to trading an option contract, and you can be on any one of those sides when you're trading options. Buyer of a put, buyer of a call, seller of a put, seller of a call. And if you want a quick little cheat sheet, here's the way you want to look at it when you're looking for which direction or where does that contract lean. So if you're a buyer of a call, you want things to go up. That's kind of simple and explanatory. Right? A buyer of a put, the same thing. If you have the basics down, you're looking for that price to actually go down in the stock. Now, if you're a seller, it actually works opposite. So if you're a seller of a call, you actually want prices to go down, because if you're a buyer, you want prices to go up. So being a seller, you want opposite of what the buyer wants. And the seller of a put is the same thing. It's opposite of the buyer of the put. So a buyer of a put wants things to go down. So if you're a seller of a put, you actually want the prices to go up. So long story short, these are the combinations that you have available. There's your quick reference guide. Let's take a look at the risk profile picture, which really makes a lot more sense when you get into looking at options. So here's our risk profile or profit picture when it comes to selling a put. And if you've never seen this before, here's a quick little insight for you. So we have our basic 0 line here on the chart, and anything above that 0 line is profit. Anything below that 0 line is loss. So profit and loss is dictated here on the left. Now on the bottom, these numbers is the stock price. So as the stock price heads higher, you can see what happens to the graph. So our profit kind of stays the same when we sell a put. We have a max profit that we can make right there at that exact point. Now, the problem with selling contracts is you have unlimited loss. Now, when it comes to selling a put, your unlimited loss actually can only go down to 0 because the stock price can only go to 0. Now, when it comes to options, you have 2 main things on the profit picture. Is you have a profit picture of the line at expiration of that contract, and then you also have a line that's today. Now, with time, that line gets closer and closer to the line that's expiring. So you have that decay. Now, the good thing about selling a put contract is this line gets closer, so you make more money as it gets closer to that expiration. So take, for example, you're selling this put contract and you're over here at this price point, right at the zero line, right around the $22 range. Now, with time, that line will get closer and closer, and at expiration, you make quite a bit of money. Now, if that stock price actually goes up to, let's say, $35 a share, within the next 24 hours, your profit potential would be, a little bit higher. But if you can hold it up until expiration, you actually would make the most from that contract. And it doesn't matter if the stock stays above 25 and it's 25.05, or if it's 60 or 150, you would make the same amount. So the issue with selling something is you're capping or creating a max profit potential. Whereas if you're buying a call or buying a put, you actually have more unlimited profit potential. So if you bought a put, you're looking for unlimited profit potential as the stock goes down up until the 0 point. And if you're buying a call, it's going to look slightly different. So for buying a call, you're going to get a chart that looks something to this effect. But then you still want the stock to go up, but at least you have that unlimited upside potential. Whereas when we sell a put, we make a maximum on our contracts. But when you're buying a call, you make an unlimited amount. Now, the problem with buying a call over here on this top right section is you're losing money day in and day out. Whereas when we're selling this put, we actually make money day in and day out. You'll see that here as we go to the charts on screen at the trading platform. So let's take a look at selling a put option contract on a trading platform. That way you get some more insight to how all this works. All right, so the first thing I want to do is go ahead and buy a single call, just so that way you can see what that looks like. So if we buy a single call, you can see I'm still looking for upside, but my upside potential is pretty much unlimited, right? It's going to the upside. My max risk is right there, negative about $163 right there, which you can tell by this little green amount right there in the lower left, or also the amount that I'm buying that contract for. So that's buying a call contract. Now, if we're buying a put contract, okay, buying a put contract, you're looking for that stock to actually head lower. And again, you get unlimited to the downside, right, up until it hits zero. But the problem is we lose $2.52 every single day. Now, if we turn this into selling a put contract, you can see I get that upside exposure, okay, right there. So now what I want is this stock, I want it to go up to the upside or stay above at least this 145, 146 level, because our contract is at 145. So as long as that stock stays above the 145, I'm perfectly fine, right? Now, the issue, of course, is if this continues to move lower and lower in price, I can actually lose quite a bit of money because, again, this is a naked option contract. I'm selling something naked because I'm selling a single. So here, what the issue is, of course, is that major loss. Now, the flip side is if the stock price stays still, I make money. I make the $2.52. If it goes up, I make money. Even if it goes down a little bit, as long as it stays above 145, I make my max potential, which is $1.06. Okay, or in other words, $106 right there, because every option contract really allows you to control 100 shares of stock. So you can see how, even though you make a little bit less than, let's say, an unlimited upside call contract, you don't have to worry about the theta or the time decay, right? The time decay actually works in your favor. And also, you don't really need that stock to move. Whereas if you buy a call, you oftentimes need it to move to the upside. In this case, that stock can actually stand still or even move down against you a little bit, and you could still make the maximum amount from this position. So that's ultimately one of the huge advantages to selling these put contracts, because it allows you to really have a larger chance of success as you put on these trades. So ultimately, most traders, what they're doing is they're selling contracts similar to this, and they're collecting the theta from it right here, letting those contracts expire day in and day out. So thanks for joining me in this week's video. Hope you enjoyed it. If you want to see some more in-depth option training, or you want to see my detailed option trading courses, then by all means visit my website at tradersfly.com and it'll route you to the courses page there. Just find the button that says courses and it'll point you right there. If you want to go ahead and join me on a live session or a live class where I also share with you some insights about the charts and current market conditions, or join me for a Q&A session, then click the button right up here. When you click that button, enter your name and email address and you'll be added to the newsletter. And that's where I send out the registration details for any live webinars, as well as promotions and news about any future courses and training material. Thanks again, and in the end, remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.